Good afternoon, committee. You are in the Finance Committee returning for a second briefing today, and we currently have the Maryland Auto Insurance Fund to give us an update. So would you like to come to the table, please? Thank you.
Good afternoon.
Good afternoon. Hope all you guys are having a great day today. Thank you, Chairwoman and Vice Chair, my fellow Baltimorean, good friend, Senator Hayes. It's good to see you. It's great to be in front of this committee today with our director and my colleagues. For those of you that don't know, my name is Devon Brown, and I am the new Government Relations Manager for Maryland Auto Insurance. And it is great to be here to kind of talk about the important issues and the critical work that we do at Maryland Auto, and to also extend an open hand to partner with you guys on ensuring that we are able to protect Maryland roads and Maryland drivers. Maryland Auto's mission is twofold: to ensure that we continue to make Maryland roads safer by reducing the amount of uninsured drivers, and to provide accessible insurance options for those who are unable to obtain it through the regular market. And Senator Gao, who I respect, who I've had an awesome opportunity to work on some bills last year with, I'm sure that you will agree with me, as will you, Senator Washington, when I say this, that every driver in the state of Maryland deserves to be protected. And that's what Maryland Auto is here to do, to make that a possibility. And so today's presentation is really about strengthening collaboration and understanding. And we want you guys to leave today with an understanding of who we are, what our challenges are, and to kind of talk about the solutions that we are working and committed to providing to ensure that we keep Maryland roads safe. And so today's presentation will be led by our director, Director Al Radmer. And we're also joined today by our Associate General Counsel, Attorney Joe Danahy, who is in the middle, as well as Dennis Curl, who is a contract attorney through our office. It is important to note that Attorney Dennis Curl is the former Deputy Insurance Commissioner, as well as the former General Counsel for the Maryland Chesapeake Employer. And so with that said, I hope you guys walk away with a better understanding of Maryland Auto, and willing and ready to go to work to protect Maryland roads. And so with that said, Director Al.
Thanks, Devon. Good afternoon, Madam Chair, members of the committee. As always, it's a pleasure to be here. Maryland Auto was created by the General Assembly 50 years ago in an effort to reduce the number of uninsured drivers by offering coverage to those that had problems getting it in the standard market. Understanding the challenges of insuring these kinds of drivers, the legislature included an assessment mechanism to act as a financial backstop, similar to what occurs in every state of the union. 40 years ago, in 1985, understanding that the major hurdle for folks getting insurance oftentimes is the cost of it, the legislature mandated us to consider affordability in determining our rates, and we have done so for the last 40 years. So, Madam Chair and members of the committee, I'm proud to tell you that we are doing exactly what we were mandated to do, but more importantly, we're doing it efficiently and effectively. Maryland Auto, our Board of Trustees is appointed by the governor, and I'm happy to tell you that every member of our board is professional, they're engaged, and they take their role very seriously. We have approximately 200 employees, and these are the kind of employees that you would see in every other auto insurance carrier. And it's important to note that our general and administrative expenses hover around 10%, which I would put up against any insurance carrier. Further evidence that we are conducting business very efficiently. When I arrived in 2020, I was pleased to learn that we had a great team in place that I inherited, and we've made that team even better. Like all carriers, we are subject to regulation by the Maryland Insurance Administration. In addition to that, we have an internal auditor, and we are also subject to an annual audit by an external independent auditing firm. So let's talk a little bit about the insurance basics. Maryland requires every driver to have insurance, and the minimum amount of coverage that we can have is $30,000 per person, $60,000 for the accident, and $15,000 for property damage. It's important to note that 71% of our policyholders only have liability coverage. They don't have comp and collision. We offer it, but they choose not to buy it. More importantly, 99% of our policyholders only have the minimum limits that are allowed by law. And I'll point out that there are many carriers that won't even offer minimum limits. You have to buy more than that. And, I bet if you go home and you look at your limits, I guarantee you nobody here has minimum limits. And it's not that our policyholders don't understand the need for higher limits and the value of higher limits. Rather, they just simply cannot afford it. They want it, but they want to do the right thing, and they buy coverage. So our policyholders have to be Maryland residents. They have to have a driver's license or a registration. It's important to note we can't offer you insurance. We can only offer coverage to folks that have been canceled by their current carrier, or if they're out shopping around, they have to be turned down by 2 carriers before they can come to us. Understanding our mission, we don't check anybody's credit. We don't ask them about their employment, and we don't ask them about their education. And the typical profile for our policyholders, they're typically younger, as you can imagine. Most have some kind of financial challenges. That's why they have to come to us. And many have English as their second language. It's important to note that 52% of our policies cancel before the end of the year. I mean, that's significant. Half leave before the end of the year. Now, some of them will leave and go into the standard market, and that's why we're here, to be a stopgap. Others will just, get rid of their car and stop driving. But there's a lot of folks that what they do is they buy their old clunker, they come to us, they get a policy, they pay a month or 2, they stop, but they continue driving uninsured. Now, this chart in front of you is fascinating and kind of tells our story. Now, again, we can't proactively go out and drum up business. We can't. We get what's left over from the rest of the industry. When I arrived in May of 2020, which is all the way to the left, we had about 30,000 policies. Now, think back to May of 2020. I arrived at what I thought was the end of the pandemic, but it wasn't. The state was closed. Most people were not leaving the house. They weren't driving around, and if you're not driving around, you're not hitting things. So what happened was the insurance companies were paying out less in claims, and they ended 2020 flush with cash in the bank. And Business 101 is, if you've got capital, you have to deploy it, and they decided to deploy it, many of them, by buying market share. they dramatically reduced their price, but more importantly for us is they liberalized their underwriting. They began writing risks in 21 and 22 that they would not have taken previously. So as a result of that, if you look at the chart, we lost policies each and every month while people went to the standard market. And again, that's okay. That's why we're here. But once the economy opened back up again and people started driving, and as you know, driving 270 or 97 or wherever you happen to drive, people are driving faster and crazier than they ever have before. So once the economy opened back up, we were back full load into the demolition derby, and people started hitting things. They were hitting things faster and creating more damage. Insurance carriers around the country lost historic amounts of money. One that you would know lost, I think it was 12 or 13 billion dollars in 1 year. And as often happens in many industries, there's an overreaction. The pendulum swings. So these carriers decided to dramatically increase their rates, but more importantly, again, for us, is then they dramatically tightened their underwriting. They got much more selective. They stopped appointing new agents. They stopped marketing. You don't see Geico ads today like you did 5 years ago. They didn't want the business, and those folks have to come to us. And they did it by underwriting. Others are much more subtle in how they avoid writing low-income individuals. You know, the MIA took action against a carrier a couple of years ago. Others are more subtle. So as an example, 6 months ago, if you call a major carrier and ask for a quote, they give you a quote. If you want to buy it, they're going to require a 40% down payment. Now, if they want a 40% down payment, who is it that they're trying to avoid giving coverage to? Secondly, if you go to get a quote, they're not even going to give you a quote unless you also promise to give that to buy a homeowner's policy. Okay? Well, what if you don't own a home? You don't have a homeowner's policy. So once again, who are they trying to avoid with their underwriting practices? They need to come to us, and you can see beginning in the middle of 2022, our policyholder count doubled over the next 2 years as they avoided writing folks primarily in low-income situations. And I'll point out, we believe that's beginning to change. We believe that the market is going to open back up again. So let's look at some rates, insurance premiums. Now, as we review, bear in mind, we have a rate increase of 13% occurring later this week. These rates that you're looking at do not include the 13% rate. These examples are for a 34-year-old male driving a single 14-year-old Honda Accord. 14 years old, one vehicle, and it includes any benefits afforded by our affordability index, which we'll talk about a little bit later. So in these examples, we're showing a driver with a clean record. Yep, no points, no tickets, crystal clear. And we're also showing, as an example, one that has one at-fault accident and one ticket. The chart on the left is for minimum liability coverage only, and the chart on the right is more typical coverage that has a little bit more liability and also includes comp and collision. Now, in the example for liability only in Baltimore City, we're looking at $2,500. Now, again, this is a single 14-year-old vehicle. For the guy that's 34 and has an accident and a ticket, it's $4,000. For minimum liability only coverage, I think you'll agree, we're not giving anything away. Now, with full coverage, Baltimore City, those premiums go to $6,600, for a clean record, $10,000 for somebody with an accident and a ticket. $10,000. And as a reminder, one single 14-year-old Honda with the benefit of the affordability index. Now, Madam Chair, if you take a peek at Anne Arundel County, you'll see it's not as dramatic, but the premiums are still significant. And I would invite each of you, go home this weekend, relax a little bit, call your own insurance professional and say, just for fun, take my information and run a quote with Maryland Auto and see the shocking numbers that you get. So I talked about the affordability index. So as a reminder, the consideration, the mandate to consider affordability came about 40 years ago by the General Assembly. As mentioned, each of our rates are reviewed by the Insurance Administration. And while the mechanism to look at affordability has evolved over the years, this is the way that it currently works. So currently, we look at each zip code in the state. We look at the median income in that zip code, and we strive to keep the premium for minimum limits, liability only. So not comp and collision, not increased liability, only for the minimum liability limits that are mandated by law. We strive to keep those premiums within 3.3% of that median income. Now, again, 96% of our policyholders are minimum limits. Okay. Now, what's struggling for low-income individuals, if insurance, as you know, is done by territory. Now, each carrier does it a little bit differently, but it's based on a territory. And typically, insurance rates are highest in urban communities. I mean, it makes sense. That's where you have all the congestion. You have people. The more people you have driving, the more likely you're going to hit somebody or somebody's going to hit you. So in urban communities, insurance rates are the highest. And oftentimes in those same urban communities, there are pockets of low-income individuals. So without our affordability index, again, that 3.3%, without the affordability index, the rates in those communities would rise by 20 to 40%. And my comment to you is, with that kind of a significant rate increase, 20 to 40% in low-income communities, that would significantly increase the number of uninsured drivers. Now, the Insurance Administration does not like the affordability index mechanism that we use to look at the affordability. And we've told the MIA that we will look for alternative mechanisms, and we've already begun that process. The MIA issued an order, a month and a half ago, I guess, that does a couple of things. They are requiring us to have adequate rates by the end of 2026. They are mandating that we eliminate the affordability index by the end of 2026. And again, if we're forced to do that, we raise rates 20 to 40% in low-income communities in 2026. Again, the assessment mechanism was created 50 years ago. So what's going to happen is our board will certify an assessment in March of 2025 based on our financial results of the end of 2024. Now, we will not know the final amount of the assessment until we close the books on 2024. Now, we're getting close, but we still have to run the numbers by our actuarial consultants to make sure it passes the smell test. And we also have to get a confirmation that the numbers are good from our external auditors. After we close the books in November, we were projecting the assessment to be for $21 million. As we work through the December numbers, we are hopeful that it's going to be less than that, maybe even a little bit less than $20 million. It'll be significantly less than that based on our projections for 2025. To add some context to that, if it were a $21 million assessment, the assessment would equal $3 for every $1,000 of insurance premium. So for if you're paying $2,000 a year, that's a $6 assessment. So the timing is the board certifies it in March. The invoices go out to the carriers based on their market share, and they have to pay the invoice by the end of June. Now, the carriers have options on how they're going to handle the recoupment, that assessment. So the first option is they can just elect to absorb it, which they won't do, but that certainly is an option. The second option is they can build it into their expenses like they do all their other expenses and put it into their rates. So as an example, they pay all kinds of assessments already. There's no line item on the bill. They build it into their rates. They can do that with this assessment as well, or they can recoup it from their policyholders. Now, and next we look at, all states, carriers pay assessments based on organizations doing what we do. In many of the states, as you can see there, recoupment from the policyholders is not permitted. And then next, we have an example of some of the other assessments that carriers already pay. As an example, they pay an assessment to the Maryland Insurance Administration every year. That's partly how they are funded. And then we can look at the reasons for the assessment. So, over the years, there's been a decline in our surplus because of claims, but also because of reduced investment income. So, as you know, fixed income investments, which is where insurance companies have most of their money, went through a period of, over a decade with very low interest rates that hurt us and every other insurance company. And then claims. So I mentioned people are driving faster and crazier. If you hit something and you're driving faster than you were 5 years ago, that causes more damage to property. It also causes more injury to individuals. Coming out of the pandemic, we had supply chain issues. So you couldn't get your car fixed in 2 days. You may have taken 2 weeks. The supply and demand factor increases the cost of the parts. We have to pay for a rental car for a week or two instead of a couple of days. There's a whole variety of reasons why the cost of claims went up for all carriers, but disproportionately for us. Our policyholders being what they are, they have more claims per policy than other insurance carriers do. Also, we are much more susceptible to fraud than other insurance carriers. And the biggest reason for the assessment is the mandate for us to look at affordability. So as I mentioned, with the affordability index, our rates are 20 to 40% lower than they otherwise should be in low-income communities. So anytime you are pricing any product 20 to 40% less than you otherwise should be charging, you are going to lose money. And that was a significant reason for the decline in surplus. Now, again, there are organizations that do what we do all around the country. Now, they don't do it as cost effectively or as efficiently as we do, but it occurs all around the country. And at the bottom of this, I'll point out the uninsured motorist coverage. Now, I'm sure you know this. If you're driving around and you are hit by a driver that doesn't have insurance, it's your insurance company that's going to pay the bill. And all of us pay for that in our insurance. So if you go home and you get your car policy and you blow the dust off of it and you look at your premium, you will see you are paying for uninsured motorist coverage. Now, in Maryland, because we look at affordability, we are insuring a lot of folks that otherwise would be driving around uninsured. And I can assure you that the amount of uninsured motorist coverage you pay is less than a lot of other states. If you look at DC as an example, DC does not look at affordability. Their rate of uninsured drivers is much higher than ours, and you can see their uninsured motorist coverage that they pay for is almost double what it is that we pay for. So my context and my perspective is that the amount of money we save Maryland drivers with reduced uninsured motorist coverage rates is a good deal, considering the $5 or $6 assessment that they may or may not receive later this year. So where we are is well, let's look at what we've done. So in 2024, we had a significant increase, especially with comp and collision. We followed up with another rate increase for 11%. However, the MIA didn't think that was enough, so they asked us to withdraw it. We did. And again, we now have a 13% increase that's going to be going into effect later this week. And I'll point out that those other rate increases were before we got the MIA order. So we were being very proactive. We're going to do another rate increase in the summer. And at the end of the day, our objective is to have our rates be fully adequate, and we're almost there, except for those areas where we have the affordability index. And Madam Chair, I appreciate everybody's patience and am happy to pause for questions.
Thank you. Thank you, Mr. Redmore. I see a question from Senator Washington.
Thank you, Madam Chair, and thank you all for being here.
Sure, thank you.
Great, it's really great information that you have here. I just want to go back to the slide that you had the zip codes on for each of the for the different areas.
Yep. Yes, sir.
I just had it. Can you remember what page number that was?
Slide 8.
20?
8.
Slide 8.
Thank you. Appreciate it. Thank you. On here, you mentioned earlier that, a lot of the urban areas have higher premiums. And I know that a lot of the urban areas are connected.
Sure.
But as you go from one zip code to the next zip code, it increases.
Yes.
Can you just describe why?
Why?
Correct.
So it's
If they're contiguous.
sure.
zip
Yeah.
codes.
It's all based on congestion for the most part, and there are differences within zip codes regarding accident rates. So I'll give you an example. I grew up in beautiful downtown Perry Hall. Perry Hall is in Baltimore County, and my zip code was 21236. So if you're familiar with that area, think Bel Air Road. And 21236 begins at the Baltimore City line, and then it goes north and ends almost into Harford County. So 21236 down south near the Baltimore City line is very congested and urban. Where you get out to the north, it's much more suburban. 20 years ago, it was rural. So if you are driving, if you look at the accident rates inside the Beltway, let's say, they're going to be much higher than they are in the northern part of the district. That's why I'll put my private sector hat back on. That's why folks ought to shop their coverage, because not every carrier uses zip codes.
Which carriers are those? I can't.
I don't know off the top of my head, but if you shop around, there will be some carriers that use zip codes as a territory, and other carriers use territories where there are multiple zip codes.
If you could point those to me, all the companies I talk to, they all use zip codes as their indicator. And you just made a really great point, which is one part of the area might be, might be an urban area where it's densely populated.
Correct.
And the other side might be more rural.
Sure,
If
right.
I move into this area, why am I, and they're contiguous, why is my insurance rate, I can go from one zip code and literally across the street to another one, and
Yep.
my rate increases. And is that fair to use zip codes if that happens? If I just go across the street and go into another zip code, but my rate will increase significantly because I move across.
Yeah, I can't say that it's fair, but that's the common practice. That's why I say it's, everybody should shop coverage to see who might do it differently. Now, one of the things that I will say, again, the Insurance Administration does not like our affordability index because we use zip codes. They would rather us use individual financial information. Well, we currently don't have that, and we're exploring, can we do it on an individual basis? The bad news is it'll be some IT cost to do that, but that's one of the things that we're exploring, again, to see if we can continue to look at affordability, but do it in a way where our regulator doesn't have as much heartburn.
You just indicated that the fairness you didn't want to really answer that question, but you understand that moving across the street to another zip code, you automatically increase. Is that right?
Correct.
It could increase, right? And is there something that you guys are looking at to make it more of a area or like a larger area instead of using zip codes? Is there another way of this industry looking at it versus
I'll
using
get you an
zip
answer
codes?
for that. I don't know that we are, but I'll get you an answer to that. I will also say that it's a two-way double-edged sword. So if you are going back to 21236, if you are inside the Beltway, where it's more congestion and more accidents, you are going to benefit from being in the same zip code with an area that has less accidents. The reverse is also true. If you're in the northern, more rural part of that zip code, you're going to be paying more than you otherwise would.
Is there a study that shows that all the zip code, the number of accidents that happen in each zip code that's publicly available for folks? Like if you're saying that in a particular zip code, you guys go off of the number of accidents that happen in that zip code, is that data available that you all use to determine the rate?
No, the Insurance Administration gets that information for the purposes of making sure that rates are adequate and not unfairly discriminatory, but is not publicly available information. I don't believe.
So then how do you guys determine how many accidents happening in a zip code if you don't have that information?
So, no, we have it. I'm talking about it's not publicly available. It
not
goes to the
publicly
Insurance
available.
Administration. Correct.
Okay, should it be publicly available?
The industry would probably say no because it's confidential, proprietary, and those kinds of things, is my guess, but I don't know.
Okay, so that's a guess, because I would think that if
Dennis?
an accident happens, that it's.
I just wanted to add one thing, that
Yeah.
the loss experience that insurance companies use is their loss experience. It's not every
Correct.
accident that happened in Baltimore City.
Right.
It's accidents that happen or thefts that happen
That they're
within-
aware of.
No, that were within our book of business.
Right. So we
So
don't.
things that are reported to the insurance
Yes.
companies.
But yes, but we have a different.
Not public data, not talking to the police
No.
department.
Correct.
We have a different loss experience than Geico or Allstate. They get their own loss experience, and they judge by whatever territory they're using, whether it's zip code or bigger territory, they judge their losses for that area, and that's what they base rates on.
I can't wait for you to tell me where this company is that has that that larger area outside of zip codes. Every company,
I don't know.
Every company. Well, this gentleman mentioned that there are some out there. So I'm wondering where those companies are and how do I contact them and figure out what their rates look like and if they're different from your rates or different from another insurance rate. Let me ask you another question. On your page 9, top of the line, it says this is the amendment that you're talking about the Maryland Auto Affordability Index.
Yes,
Is that's only for you all? Is that right?
correct.
That's only for you.
Yes.
Doesn't apply to any other companies.
Correct.
At all, right?
Yes, sir.
And you're saying that we need to and the recommendation. You said someone made a recommendation to remove this index. Is
The
that right?
Maryland Insurance Administration is requiring that we eliminate the use of the affordability index by the end of 2026.
Got it. Okay. Got it. Okay. And making a recommendation, but we would have to pass a law. No.
No, the insurance commissioner, in response to our rate filing, disapproved the rate filing and ordered us to phase out the affordability index. She did not say we couldn't necessarily use affordability, but we couldn't do it in a way that we've done it.
And
That was her. That was her order, and she regulates us. So
And why
we
does she
made
make
the
that?
order.
Why does she say that?
She doesn't like, I don't want to say she, the Insurance Administration does not like the affordability index because they believe it's discriminatory. And it's discriminatory in this way. If you are in one of the areas where we have the affordability index, because it's got a low median income, if you happen to be a rich, wealthy guy and you move into that low-income community, you're going to get the benefit of the affordability index. By the same token, I know. Trust me, I know.
This sounds crazy.
If you, by the same token, if you are of low income, but you're living on your cousin's couch in Potomac, you're not going to get the benefit of the affordability index. So that's their concern.
How many areas have this index? How many areas in the state?
How many?
50 zip codes.
50 zip codes?
50 zip
Out
codes.
of how many in the state?
477.
Yeah.
450 zip codes out of 477. And where are they mostly?
They're centered around Baltimore City primarily.
Okay.
Also,
all 50?
No. There are some individual zip codes throughout the state.
Yeah.
They're primarily in and around Baltimore City.
Do you have that list?
We can get that to
yeah,
you.
we'll get that.
Okay. I would love to have that list. Thank you, guys.
Thank you, Senator. I will tell you, there are a number of bills coming in from various sponsors about the Maryland Auto Insurance Fund. So you'll have lots more time to ask these questions in bill hearings.
Well, thank you. You just made my day.
Sure, Senator, go ahead.
Just real quick, just one quick question. Does the Maryland Auto Insurance Fund utilize the tracking method for cars to determine how they're driving?
No. We
And then tell me why not, because other companies are using it.
we flirted with the idea of that a couple of years ago and determined that it was going to be too costly to do that from a
To
technology.
you or to the consumer?
Well, to us, and obviously we've got to pass along what we can, but yeah, to us.
Got it. Thank you.
Thank you, Senator. Senator Ellis?
Thank you, Madam Chair. I have a quick question. So last year, another briefers, the briefers talked about homeowners insurance, how it's underwritten statewide, not by zip code. But auto insurance is written by zip code. Is there a law that says that, or is just a choice of
Choice of the
the
carrier.
industry?
Yeah, it's choice of the industry to determine how they want to determine their territories.
Yeah.
Territories, yes.
So if we pass a law saying that, hey, auto insurance, statewide underwriting, then they would have to do that.
Correct.
All right, thanks. Thank you, Madam Chair.
You might see your rates go up if you did that, Senator Ellis. Thank you. I don't see any other questions for this panel.
All right.
Thank you all very
Thank
much.
you.
Thanks for being here. Very good presentation. We're going to take a break for just a couple of minutes while our committee manager sets us up for bill hearing, so thank you.